Hello, everybody. Thank you for joining me. Today is the day that we have been waiting, I'd say a little over a year for. For sure, it's the day that we've been waiting since March of 2020 to hear these magical words, which is the Federal Reserve has lowered interest rates. And everybody is celebrating. As a matter of fact, the rate drop today was bigger than what anybody expected. It was equal to the biggest that anybody expected. So here's the bottom line. The bottom line is mortgage rates right now are the same as they were yesterday. Tomorrow, they're going to be probably the same as they are today, because the drop in the Federal Reserve rates was already expected. And everybody is putting on the news and they're hearing in the advertising that, oh my gosh, rates have come down. I've got more calls today, and I expected these, but I got more calls today from people saying, John, how much lower are rates now that the Fed dropped rates 0.5%? You told me the other day that rates are at 6% or 6.25% or 5.5%. So now they're 0.5% below that, right? No. And I need you to understand a little bit of history here. Simple explanation. The Fed has not raised interest rates. They haven't changed rates at all since June of 2023. It's been over a year since the Fed has changed interest rates at all. Yet in June of 2023, rates were probably around 7%. By October, they went to 8%. By December, they were back down to around 7%. And by now, they've gone down to 6%, and in some cases around 5.5%. So we've seen interest rates move a lot in the last 12 months. But the Fed hasn't changed their rate at all, which is the ultimate proof that the Fed does not control mortgage rates. The Fed reacts to the economy. The Fed is trying to steer the economy in a certain direction. And so the Fed has to make sure of two things. They have to make sure that we keep inflation under control and that we keep people fully employed. We keep the maximum number of people with jobs. And the Fed uses raising and lowering of interest rates as one of their tools to play with that. And so the Fed, what happened right now is the Fed basically said, look, we agree we've won the battle against inflation. Inflation is what caused mortgage rates to go up, not the Federal Reserve. So inflation went up, mortgage rates went up in response to inflation. The Federal Reserve raised their rate to bring down inflation. Inflation has been going down already. That's what caused the mortgage rates to drop from 8% last October to 5.5% to 6.25% right now. Yet the Fed hadn't lowered their rate at all, because the Fed's raising and lowering of rates is the medicine that was fighting inflation. That's the simplest way that I can put it. Now, there's good news. There's really good news, but I want you to put it into context, because what we're dealing with right now is we're dealing with a stock market, a bond market, a mortgage rate market that's trying to read the tea leaves about where the economy is going. What's going to happen with inflation? What's going to happen with jobs? Because if the economy goes into a recession, that actually is good for housing and it's good for interest rates. And so if a lot of jobs start getting lost, the Fed is going to lower interest rates to try and be the medicine to bring jobs back into the market. But mortgage rates are going to fall because we're heading into a recession, not because the Fed lowered rates. So get it out of your thinking that the Fed controls mortgage rates. They move the same direction most of the time, but it doesn't control it. And so when the Fed said we lowered rates 0.5%, we did not lower rates 0.5% today in response. But here's what we did see. By the way, if you have questions, feel free to post into comments and I'm happy to answer those questions. But here's what we did see. This is what's called the dot plot. Okay. So this is the Federal Reserve. Their rate right now is between 5 and 5.5%, 5.25% and 5.5% has been the range of the Federal Reserve rates. And it's been that way since last year in June. And every meeting, the Federal Reserve puts out projections. The dot plot is their projections of where they expect rates to go in the future. That was the big story today. Because in June, the red dots, the Federal Reserve said, hey, in 2024, there's 4 of us that think rates aren't going to change at all. So their meeting 3 months ago, they said 4 of us on the Federal Reserve Board think rates aren't changing at all. Another 7 of us think rates are changing by 0.5%. Another 8 of us think that rates are going to change by 0.75%. Quarter and a half. So some of them thought it wasn't going to change at all. Some of them thought it was only going to change by 0.25% before the end of the year. And a few of them, a majority, said, no, we think they're going to change by 0.5% before the end of the year. Now what we've got is 2 of the Federal Reserve members saying, yeah, I think that where we're at right now is all we're going to have, because we just dropped that 0.5%. So 2 of them say we're done for the year. But everybody else says, no. We got another 1/4 or another 0.5% in us for sure before the end of this year. So they're giving us tea leaves to read. And what they're saying is we expect rates to go down further. What that tells us is that they have more concern about where they're at, and they're making it clear we know we need to keep lowering interest rates. That in and of itself is going to lead to lower mortgage rates, because we don't wait for the Fed to make the change. We are projecting what the Fed is going to do based on this information. So then you look at next year. Now, again, this was June 3 months ago, when one of the Fed members said, we're still not lowering rates. I think that rates are not going to drop at all between now and the end of 2025. That was June that they said that. One of them said, yeah, it'll drop maybe 0.5%. We're already here right now. As a matter of fact, this one Fed member said we were going to have 1 rate decrease by 0.5% sometime in 2026, and that's it. Okay. So there were a lot of people on the Fed that were saying rates are going to stay high for a lot longer. And they had some more people that were saying, yeah, we think rates are going to go down next year a fair amount. But what you're seeing right now is you are seeing that the Fed made it clear, no. We expect that rates are going to be down here. This is Federal Reserve Funds rates. This is not mortgage rates, but it's how many rate cuts they're going to have. And we expect more rate cuts this year, but we expect a lot more rate cuts next year, a lot more rate cuts in 2025. That's the story that is going to lead to lower interest rates over the next 6 months. I think that the market is going to digest this. The market is going to look at, Fed said today, Jerome Powell said multiple times, we're going to read the data, we're going to read the data, we're going to read the data. That's all they care about is the data. What is happening with inflation, they're not as worried about. What's happening with the job market, they are worried about. And they're worried about, are we going to head into a recession? And so the mortgage world, the stock and bond market, they're looking at this dot plot that we've got right here, and they're comparing it to what the data continues to say. And that's what's caused interest rates to drop from the last almost year, October of last year, from 8% to around 6% right now. And it's what's going to lead us lower in interest rates from here forward. But the key to understand is when the Fed says we dropped rates 0.5%, it did not make any difference. As a matter of fact, the market's a little bit higher as at the end of the day today than it was in the morning, because some of the things that the Fed said and the way that he said it gave some pause in his wording about what we expect to see in the data. But as the data comes out for the rest of this year, I expect we're going to see interest rates stabilize and start dropping a little bit more. Now, that's a double-edged sword, because for those of you who are looking to purchase a home, you have to decide, am I purchasing a home right now while everybody is scared about, well, what is happening with the economy? Gosh, John just said that we might end up in a recession. And my parents said buying in a recession is a bad idea. And your parents said that because the last recession that they bought in was 2007, the Great Recession. And that recession was caused by housing. That did not cause housing to go bad. Bad housing caused that recession. So you have to understand there's a very, very big difference between what's happening now if we end up in a recession versus what happened in 2007. Recessions, every other recession, interest rates have dropped and house prices have gone up. The other thing people are worried about is politics. What's happening with the election? Who's going to win? Is it going to be red? Is it going to be blue? Is it going to be purple? I don't know. But what I do know is there's still going to be a housing market. There's still going to be a job market. There's still going to be the Fed. There's still going to be inflation. And Interest rates are in general moving down because inflation is getting under control and jobs are becoming the worry. And when it flips from one side to the other, this is something I said a year and a half ago. When the market turns, the Fed has overcorrected. The Fed has waited a long time to actually drop interest rates. Now that they've done it, they are showing on this dot plot that I showed you, they're going to have to drop rates quickly. And so if you were looking to buy a house, what you have to understand is right now, I see a lot of people sitting on the sidelines. I actually see more people coming back in right now. 2 weeks ago, I saw a lot of people sitting on the sidelines. So I think people are starting to say, hey, maybe this is a good time. But many, many people don't like to buy during the holidays. So we're going to see a little bit of a pickup between now and maybe November 1st. And then by mid-November through the first week of January, I think we're going to slow down like we normally see around the holidays. But then we're going to pick up, and I think it's gangbusters next year. I think we're going to have more sellers willing to sell their house because, hey, you know what? Now that rates are in the 5s instead of the 7s, it's not so bad losing my 3% to go to 5. I didn't want to lose my 3% to go to 7. And so I see the housing market next year loosening up a little bit. That grip that was holding on to the market, that was what we called the rate lock effect. Now, we're not getting back down to 3% anytime soon, but the Fed was asked a really important question today. They said, there's an entire generation of people that have never seen high interest rates. And here we are, and we've hit what historically isn't a bad rate. The rates right now historically are not bad, but it's clear they're too high. The Fed said they're too high. They said they are what's called restrictive or holding the economy back, and they have to lower interest rates. And so by the Fed saying that, this reporter during their press conference said, does that mean that low rates is the new norm? And I believe that's the case. I believe that just like any kind of enhancements that have happened through any of the industrial age, the Bronze Age, that when we invented the assembly line, it changed everything. When we invented computers, it changed everything. It makes things more efficient. It makes them move faster. The globalization of the economy. The fact that the economy isn't just about the United States, it's about the entire world now. And we already have a bunch of, Jerome Powell said today, the chairman of the Federal Reserve said today, look, we are the last of the developed economic nations to lower interest rates. Everybody else has already lowered them, which says everybody sees that rates have to be lower going forward. The cost of the economy is becoming more efficient. The cost of money has become more efficient. It doesn't need to cost 7 or 8%, which was a great interest rate back in the 80s compared to the 15 or 20%. And when it went to 15 or 20%, everybody said we're never going to see rates again any lower. In 1993, when rates shot up and we were seeing rates at 9 and 10%, and everybody said we're never going to see rates any lower. Never doesn't happen. Everything is a cycle, and we're on the downward side of the cycle. So now becomes the shift in advice. We're going to have to shift our thinking about how we move forward. So 2 years ago, it was, hey, date the rate and marry the house. Well, for some people that worked out great. For some people it didn't. The truth is we expected rates to drop sooner. I wasn't a huge fan of that. A lot of people did temporary buy downs. I didn't do very many of those. I wasn't a huge fan. But the fact is our thinking has to change, because you've got two segments of people right now. You have the people who don't own a home that want to, the people who own a home, but they want to make some changes. They want to make some wise decisions about their financing. And so for that reason, I'm actually about to launch a new YouTube channel, and it's called Can I Refi? It actually exists. It's got one channel, one video, but it's about giving advice to people about, can I refinance and should I refinance? Because those are two very, very different questions. And just because you can doesn't mean you should. Just because you should doesn't mean you can. But the truth is, there's so many different components going into it, and our advice has to change. And so big picture, when you own a home, whether you own a home now or not, you're going to, because otherwise you wouldn't be listening to me. And when you own a home, you have to make strategic decisions about your financing. And 30 years ago, 40 years ago, the thinking was, hey, I'm getting a loan. It's a 30-year mortgage. I'm paying it 360 times, and then I own the house free and clear. That isn't typical anymore. It's very rare that somebody's keeping their home for 30 years, let alone their loan for 30 years. And so we have to think different about our finances. The reality is home equity is growing, and it is going to grow even faster in this upcoming cycle because we're going to see more demand, more people wanting to buy homes, and there still aren't enough homes out there for them to buy. You're still going to have people who have a 2.5% interest rate that aren't going to want to sell their home because they can't get anywhere near that low of an interest rate, and they plan on just hanging out for another 10 years until it's paid off. And then they're going to age in place, retire, and live in their home, which is a newer concept than ever before. Previously, it was like, hey, I'm moving in with my kids when I retire. I'm moving into a old folks home. I'm joking, independent living facility or assisted living facility. And the thinking was different. But now a lot of people want to age in place. Well, that's a home that used to be recycled into the market as a first-time home buyer home. And so you've got the baby boomer generation that's holding on to all of their homes. And I don't blame them. They want to enjoy their retirement, and they would rather pay to have skilled nursing come to their home than to go live in a skilled nursing facility. So we're seeing more of those homes that are not able to be sold. And so in this market where interest rates are starting to go down, we are going to see upward pressure on house prices because it's about supply and demand. And if you look at the United States across the board, and you look back 2.5 years to when interest rates started going up, most markets are pretty close to the same, if not above where they started 2.5 years ago, which is unheard of because when interest rates went up, house prices should have gone down, and they didn't. Now, why didn't they go down? Because there isn't enough inventory, because part of it, I'm not saying it's the only thing, but because people are aging in place, and because builders didn't build during the recessionary times. From 2007 to 2015, builders didn't build very many homes. And so that caused a shortage in the number of homes being created. Now we're going to feel that effect tenfold in this next cycle because we're going to see people now saying, okay, I'm ready to buy. I've seen the light, John. I've seen the lights. I want to buy a home. I want to be a homeowner. I want to not have to worry about getting permission from my landlord to paint the walls or to do some work in the backyard. And I want stability for my children. I want them to know that they're going to be able to stay in that same school, that they know that the friend that lives next door, they're going to be able to stay next door to them as they grow up, because that's something that I had, or maybe you didn't have as a child and you wanted to have, that you wish you had. And so that emotional need to have roots, to be part of a community, is something that people couldn't achieve over the last 5 years. Why? Because in the COVID times, rates were super low, but nobody could get an offer accepted on a home. And then after that, rates were super high and nobody could afford the home. We're finally in the sweet spot, but that sweet spot's not going to last very long. And if you can jump in now before prices go up significantly, you can refinance as rates go down. But refinancing requires good strategy. It requires thinking. It requires not being susceptible to all the marketing pieces that you get in the mail because somebody shows you a really, really low interest rate, because when you refinance, you got fees you have to pay. And so everybody says, John, I want to get a lower rate. That's great, but what are you willing to spend in fees? Well, what do you mean fees? My lender said it's not going to cost me anything. There's no such thing as a no-cost refinance. You're either paying for it out of your pocket, which is rare. You're paying for it through a higher loan amount, which is most common, or you're paying a higher rate than you could have gotten otherwise. Now you say, what do you mean a higher rate? Why would I want to refinance if I was paying a higher rate? Because that higher rate is still lower than your current rate. If the market says right now that you can get a 6% interest rate, then we can actually get you a 6.5% interest rate with very, very little fees. Why? Because Wall Street, who's buying that loan, says, well, man, if I'm going to make 6.5% over the next 30 years, then that extra 0.5% that I'm making more than pays for the fees that I covered. But Wall Street's smart because they know you are not going to keep that mortgage for 30 years. You're going to keep it for 2, 3, 4, 5 years. And so they're gambling and saying some are going to pay it off soon and some are going to keep it for a long time. But as rates are falling, you have to make a decision strategically, and you got to have somebody you trust to help you make that decision. I am interviewing for that job to be somebody you trust. I created my new channel Can I Refi? So search at Can I Refi on YouTube, and you can be one of the first ones on my channel. There's nothing there, but subscribe to it. You can be one of the first ones, because that's what I'm going to educate you on, is for people who bought their home a year ago, and they have a 7% interest rate and very little equity, but they didn't get the house they wanted. Why? Because their rate's 7% and they needed to compromise. And now they're realizing, man, I really need an extra bedroom. I know I compromised, but I need that extra bedroom. There's a loan for that. It's called a renovation loan. You don't have to have equity in the property, because we're going to base the loan on what the house is worth after you've completed the repairs, but we're going to loan you the money now before the repairs are completed. You've got other people that are in that position of they want to age in place, but they don't want to have to make a mortgage payment. There's a loan for that. It's called a reverse mortgage. So there's lots of ways. There's people who have super low interest rates from 2020 and 2021, but they couldn't get the house they wanted because there wasn't very many houses on the market to choose from, so they compromised. And now they need to get that extra bedroom, but they don't want to lose that really low rate. There's a loan for that. It's called a home equity loan or a home equity line of credit. And I'm going to educate you on those as well. So whether you are looking to purchase a home, whether you own a home and you want to refinance it, or you are thinking of buying a home and worried I don't want to buy too soon, because if I buy too soon, I'm going to pay too high of a rate. That's where I'm going to educate you on how refinancing works. Because everybody's recent history is refinancing is about lowering my rate. Not always. As a matter of fact, lowering your rate is the worst reason to refinance. A lower rate is a tool that gives you one of three things. It gives you either the ability to pay your home off faster and keep the same monthly mortgage payment, or it gives you the ability to extend your loan out to a new 30 years with a lower rate and lower your monthly payments. You're either paying off faster, you're saving money per month, or you are pulling cash out of the property. Maybe you're making home improvements. Well, you can pull cash out of the property and get cash in your hand to do work on the house with no increase in your monthly payment because you're getting a lower interest rate. But actually, you can accomplish some of those same goals with a higher interest rate. And you might say, John, that's stupid. Why would I want to take a higher interest rate? I had a client back in July that gave up their 2.75% 20-year fixed rate that they were 3 years into. They had 17 years left on their mortgage, and they gave up that mortgage. They gave up that great interest rate for one very specific reason, because they had a bunch of debts and their monthly payments were significantly higher between their 17-year mortgage and all of their credit card debts and their home equity loan. And their blended interest rate, their average rate of what they were spending was significantly higher than what the new mortgage rate was of 6.5. So don't get stuck saying, oh my gosh, I got a great rate, I don't want to get rid of it, because you got to think about your debt in totality. That is part of what I'm going to be talking about in my new channel called Can I Refi? So go to YouTube, search at Can I Refi, find my channel. There's only one video. It's a minute long. It's just my welcome video, but I'm going to put a lot of content in there going pretty quickly. All right. I've got a question, maybe a comment. Maria says, John, what are your thoughts on how rate cuts are going to affect Dream for All voucher holders' buying decisions? Ooh, that's a good one. Also, what are your thoughts on the upcoming initial voucher batch expiration in a week? Okay. So first and foremost, Cal HAFA didn't announce, well, they did. Cal HAFA has been granting extensions to people that got the initial voucher back at the end of June. That was disappointing to me. Now, I'm happy. I'm happy for the people who got their extension. If you're one of them, especially if one of my clients, I'm not saying I'm not happy about it. I'm saying they gave them away like Happy Meal toys at McDonald's. Everybody gets one. It doesn't matter. It's no big deal. Well, what it means is that you gave everybody 3 more months, which means those of you who are on the wait list, you got pushed back 3 more months by people that they may be looking for a diamond in the rough. I have a couple of clients that are doing that. They're looking for, hey, I'm waiting to buy a house in this neighborhood, and there's nothing for sale in that neighborhood. So I'm just going to wait because I'm not willing to buy if it's not in that neighborhood. Well, in the last 3 months, nothing's come up in that neighborhood. Yeah, technically something could come up in the next 3 months. But for a lot of those people, good chance that's not going to happen, which means they're holding a spot in line that could have been yours. Now, here's the good side of that, Maria. If you end up not getting your voucher until December, you might get better interest rates. We are literally seeing interest rates 1% lower on Dream for All. Right now, 50 days after Dream for All was launched, the first day rates were right around 7%. We're now around 6. I think we're in the high fives a couple of times. I didn't look today. But we've been at 5.875 to 6%. That is 1% cheaper. Could it go even lower by next year? Yeah, it could. We could see rates in the mid fives. We could see rates in the low fives. Look, in my career, I've seen rates rise quickly a few times. I've been doing this since 2000. So 24 years in the industry. I've seen multiple cycles where rates went up and down. Rates never started going down as quickly as we would have hoped, which that happened over the last 2 years. But once they start going down, they drop a lot faster than we expected. Now, we just saw that already. We saw, just like I said, Maria, in the last 80 days. In the last 80 days, we've seen interest rates drop on the Dream for All program by 1%. Okay, that's the same that we've seen across all of the different loan programs since June, July, is about a 1% drop across the board. That's phenomenal. So that is a faster drop than anybody expected in a shorter amount of time. The question is, where's the water level going to land? Where's neutral going to be for a period of time? We're not going to just drop. We're going to drop. We're going to come up a little bit. We're going to stay neutral. We're going to drop again. It's all news-based and what's happening with the economy. I think we start seeing more job losses. We're going to see interest rates drop even more. So the catalyst to this current drop in rates had nothing to do with today's Fed meeting. It had to do with the Fed meeting at the end of July. At that Fed meeting, the Fed said, under no uncertain terms, the time has come for us to start lowering interest rates, which meant they had to lower rates today, and everybody expected it. The time has come for us to start lowering interest rates. Those are the words they needed to hear. Now the Fed said today, we're not so worried about inflation. We're worried about employment equally with inflation. Well, everybody sees inflation's on a downward trend, but employment is what they're worried about. So if we start seeing more job reports coming in with more job losses, we're going to see another drop in interest rates. And Maria, that might help you if you're on the waiting list and you have a longer amount of time before you start shopping. But the good news is, I think if CalHAF is giving everybody extensions to their voucher right now, then they're going to be giving extensions to everybody when you get your voucher and it's time for you to extend 90 days later. I think it would be pretty unfair of them to not give it to you. I honestly think they should have used it, gotten an explanation from somebody on why they need it, and put some parameters around who they were going to give it to. But so far, they're giving it to anybody who asks for it. So I think that the Dream for All voucher holders right now, look, they have, if they didn't get an extension and they're unaware of getting an extension, I'd like to think everybody watches my stuff, but everybody doesn't. Okay. So there's a lot of voucher holders out there that are not listening to John King. They don't know about this. By the way, CalHAF emailed everybody and told them, hey, you got a voucher. Go ahead and ask for an extension. I was shocked they did that. But here's the deal. I also talked to a lot of people who didn't even know they got the voucher because they don't check their email very often. There's a whole generation of people that grew up like my generation. We use email all the time, but there's a whole generation right now of the younger generation that says, you know what? You didn't instant message it to me. You didn't text it to me. I didn't see it. Like, I don't ever check my email. My kids are in their teens. They don't check their email. What's email, Dad? I don't ever look at. That's that thing that that school makes us go on to every once in a while. Like, email is not used. So people are not seeing the emails from CalHAF saying you should get an extension. So that gives hope to those of you that are trying to buy right away. You likely can ask for an extension. CalHAF's rules are within the last 30 days of your voucher period, you can ask for an extension. So hopefully, Maria, that helps to answer your question. I actually forgot to put it on screen. But anyway, there was Maria's question. So guys, I'm going to recap. If you have questions, please feel free to ask them. Otherwise, I'm going to wrap up. The Fed today lowered interest rates 0.5%. That did nothing for mortgage rates. Okay, if you didn't listen from the beginning, it did not impact mortgage rates at all. We expected it. The Fed lowered mortgage rates because inflation is now under control. The mortgage industry lowered interest rates because inflation is now under control. So you did not see a drop in interest rates today on mortgages because mortgages are not controlled by the Federal Reserve. Your credit card rates might drop because those are tied to the Federal Reserve rate. So October 1st, you might see a 0.5% drop in your credit card rates. That's great news. Your home equity line of credit rates might drop because come October 1st, because they typically do it on the 1st of the following month, they'll lower your home equity line interest rates if they're tied to the prime rate, because the prime rate just went down by 0.5%. Those are all good things. But the rate on existing mortgage loans right now has not dropped for new mortgages because the Fed's announcement today was known for months, at least since the end of July. Everybody expected it, which is why mortgage rates have already fallen. So it's about what's expected in the future. And I'm going to repeat for one last time, it's about this chart right here. And this chart is what the Federal Reserve is expecting for interest rates to be. And in June, the red dots are what they came out saying, hey, we expect that in 2024, rates are going to be around here. In 2025, they're going to be around here. In 2026, they're going to be around here. The blue dots are what they said today. And they changed their thinking and said, no, we expect rates to be a lot lower before the end of 24. We expect rates to be a lot lower at the end of 25. We expect rates to be a lot lower. Actually, most of them expected in 26 to be here, but there's still more of them have blue dots down towards the bottom, meaning every dot is a person saying that's what I think the rate is going to be by the end of that year. Long term, they're all saying they expect interest rates about 3% lower than where they are today. That's what they're saying, because right now, before today, we were at 5.5% on the Fed funds rates. And they're expecting that long term, so after 2026, their average you're expecting somewhere in the mid twos. Okay. So we're expecting interest rates 3% lower than where they are today. Now, that translates probably to around a 3.5% to 4% mortgage rate. Okay. That's what this chart is translating. It's not an exact correlation, but it does follow, it rhymes. Okay. It follows the same patterns. And so as the Fed says they project this, does not mean that's what's going to happen, but it does help give some insight. But what I said is my biggest concern is if you're sitting on the sidelines waiting, you're going to be too late. I talked to a client today who bought a home who backed out of a home in 2018 and decided it was a bad time to buy. And they called me back and said, John, we're ready to buy now. And we regret making that decision. And the question is, are you going to regret it as well? Like you have to be courageous. You're never going to have a mortgage payment less than what you're paying in rent. But imagine if you bought the house in 2018, your mortgage payment would be lower than what you're paying in rent right now. You just have to be willing to take the leap. That's the most important thing that I want to impress upon you. You have to be willing to take the leap. And if you own a home or you're expecting to own a home and you want to understand how refinancing works, subscribe to my new channel. Again, no videos yet. They're starting to come out very, very soon. I got my first welcome video on there. Search for @CanIRefi on YouTube, and you're going to find my new channel. And I'd appreciate all of you subscribing so that I can get a subscriber base built up before I've even started publishing my videos. Anyway, I don't think there's any other questions. If you have one, start typing quickly. Otherwise, I really, really appreciate your trust. I really, really appreciate the opportunity to interview to be your lender. And that doesn't mean that I'm ever going to talk you into anything, but I want to talk you through everything. And I want to be your resource for good information for both you and for everybody that you know in your family, your colleagues at work, your friends, people you don't like. Send them all to me. I'd love the opportunity to take great care of them as well. Thanks, everybody, for listening. Have a happy Wednesday night, and we'll talk to y'all soon. Bye-bye.